Welcome to Money Mastery, where we cut through the noise and tell you what's really happening in the world of finance. Warren Buffett just sold $150 billion worth of stocks, slashing 50% of his portfolio in a single year. The man who preaches buy and hold forever just made the biggest sell-off of his career. He didn't do this before the dot-com crash, the 2008 financial crisis, or even Black Monday in 1987. So why now? Is this a warning sign? What does he see that the rest of us don't? Warren Buffett's unprecedented stock sell-off. What's going on? Let's cut to the chase. Warren Buffett just pulled off the biggest stock sell-off of his career, dumping $150 billion worth of stocks in a single year. This isn't just some routine portfolio rebalancing. This is Buffett making a statement. The man who preaches patience, long-term investing, and the virtue of holding great businesses forever just offloaded 50% of his portfolio. To put this in perspective, he didn't do this before Black Monday in 1987, before the dot-com crash in 2000, or even before the 2008 financial crisis. That alone should make your eyebrows shoot up. Historically, Buffett has been a buy-and-hold disciple, a firm believer that the best time to sell a great stock is never. He's the guy who scoffs at short-term trading, who compares selling good stocks too soon to cutting the flowers and watering the weeds. And yet, here we are. He's not just pruning his garden. He's taking a flamethrower to half of it. If Warren Buffett is making a move this drastic, you better believe there's a reason. Now, let's talk numbers. Before this massive sell-off, Berkshire Hathaway's portfolio was worth about $410 billion. After liquidating over $150 billion in stocks, his remaining portfolio sits at around $266 billion, which means he's holding more cash than stocks at this point. That's right, Mr. Buy Great Businesses and Hold Forever now has more money parked in cash than in equities. This isn't a case of selling a few overvalued stocks here and there. This is a fundamental shift in strategy. But why? Buffett himself has always been clear on the four main reasons he sells stocks. 1. If he finds a better opportunity. Doesn't seem like he's rushing to buy anything new, so that's probably not it. 2. If he loses confidence in management. Maybe for some companies, but not likely across the board. 3. If the fundamentals of the business change drastically. This could be a factor for some, like banks. 4. If the stock becomes overvalued. Ding, ding, ding. We might have a winner. This isn't just about one or two companies getting too expensive. This is about the market as a whole being overpriced. Buffett has seen enough cycles to recognize when things start looking a little too frothy. And let's be real. The market right now has all the signs of irrational exuberance. Stocks are trading at insanely high valuations. Even companies with slowing growth, like Apple, are being priced as if they're still in hypergrowth mode. And let's not even start on the speculative frenzy in AI stocks. Buffett has been here before. If you rewind to 1969, he did something eerily similar. He liquidated his investment partnership, telling his investors that he simply couldn't find anything worth buying at a reasonable price. Not long after, the market crashed, inflation skyrocketed, and a brutal recession followed. Now, he's not dissolving Berkshire Hathaway, but he's moving to cash at a pace that feels awfully familiar. Here's the bottom line. Buffett isn't just selling stocks. He's sounding the alarm. The Oracle of Omaha isn't known for panic moves, so when he sells more in a single year than in any previous crisis, it's worth paying attention. The big question now is whether history will repeat itself, and if Buffett's legendary patience will once again prove to be the smartest move in the room. Why did Buffett really sell? The Oracle's 4 Golden Rules. Warren Buffett doesn't just wake up one morning, sip his cherry Coke, and decide, you know what? Let's sell $150 billion worth of stocks today. No, the man operates with unshakable discipline and a playbook that's been fine-tuned over decades. If he sells, it's because something doesn't sit right. And if he sells this much, it means he sees something the rest of us don't, or at least refuses to ignore what's staring everyone in the face. Buffett has always been clear about the reasons he would sell a stock. No guessing games, no mystery. Just 4 simple rules. 1. If he needs the money for something better. 2. If he loses faith in the management. 3. If he loses confidence in the business itself. 4. If the stock becomes wildly overpriced. Now, let's break these down and see what applies to this historic sell-off. First, is Buffett raising cash for a better opportunity? Highly unlikely. The man is sitting on a record-breaking $320 billion in cash and short-term U.S. Treasury bills. If he were gearing up for a massive buying spree, we'd see hints of it by now. Instead, he's hoarding cash, a move that screams, I don't like what's out there. What about management shakeups? Buffett has always been loyal to great leadership. If a CEO does something foolish, or worse, dishonest, he won't hesitate to cut ties. But look at the stocks he sold. Apple, Bank of America, Chevron, Snowflake. No major scandals, no executives getting perp-walked on Wall Street. While he may have concerns about the banking industry's ability to stay responsible, more on that later, it doesn't seem like he dumped these stocks because of bad leadership. So that brings us to the 2 big ones: fundamental business problems and overvaluation. Let's start with business concerns. Buffett has always invested in companies that are simple, profitable, and durable. He's the guy who avoided tech for decades because he didn't want to bet on things he didn't fully understand. Yet, look what happened. He bailed on banks, an industry he once loved, sold down Apple, his biggest holding, and ditched Snowflake, which, let's be honest, was a weird Buffett stock to begin with. The banks? That one's clear. Buffett doesn't trust the industry anymore. He's seen the deposit runs, the reckless lending, and the fragility of the whole system. He straight up said that he doesn't like how today's banks are structured. And when Buffett doesn't like something, he doesn't stick around to see if it works out. Apple? Different story. Buffett has always adored Apple. He's called it the best business he's ever owned. But here's the problem. iPhone sales are stagnating. The company isn't innovating like it used to, and yet, it's more expensive than ever. When you combine slowing growth with a soaring price tag, Buffett smells trouble. And that brings us to the final reason: overvaluation. This is where Buffett's patience turns into cold, hard action. If he sees a stock trading at wildly inflated levels, he will sell, no matter how much he loves the company. Apple's price-to-earnings ratio has tripled since 2012, even as growth slows. That's a red flag for Buffett. Same goes for the broader market. This isn't about one bad stock. This is about Buffett seeing a market that's overheated, overpriced, and built on shaky fundamentals. And when the Oracle of Omaha thinks things are getting out of control, he does what he does best. He steps back and waits. Breaking down Buffett's sell-off. What do these stocks have in common? Warren Buffett doesn't sell randomly. He's not the guy panic-dumping stocks because of a few bad headlines or a CNBC segment screaming, "Market meltdown." If Buffett sells, it's for a damn good reason. And in 2024, he didn't just sell, he torched some of his biggest holdings. Apple, Bank of America, Chevron, Snowflake, Liberty. What do these have in common? More than you think. First, let's talk Snowflake. Now, why on earth did Buffett even buy this stock in the first place? The guy has spent decades avoiding tech startups, and yet, boom, Berkshire picks up a piece of a cloud computing company that bleeds cash. Snowflake's revenue has exploded from $500 million to $2.8 billion. But here's the kicker. It's also burning more and more money. Their losses keep getting bigger. And if there's one thing Buffett hates, it's a company that can't turn a profit. This sale wasn't surprising. What's surprising is that he bought it in the first place. Maybe he was trying to impress the grandkids. Now, Chevron. Buffett's playbook on oil stocks is simple. Buy when oil is cheap, sell when oil is high. He scooped up Chevron in 2020 when oil prices were in the gutter. And now, after a solid run-up, he's slowly unloading. This is classic Buffett. A disciplined exit, not a panic sell. He's not abandoning oil. He's just trimming the fat. If Chevron drops back down, don't be shocked if he starts buying again. Then there's Liberty Series X. Honestly, this one's a bit of a head-scratcher. Buffett sold $2 billion worth of shares, but also bought back some at the same time. This isn't typical Buffett behavior. It's more like something a Wall Street trader would do. Maybe he was squeezing out some easy arbitrage profits, or maybe he got bored and wanted to mess with the market a little. Either way, this one isn't the big story. But you know what is the big story? Bank of America. Buffett has loved banks for decades. He's been investing in the sector since 1969, and at one point, his portfolio was stacked with banks: Wells Fargo, JP Morgan, US Bank, Goldman Sachs. But one by one, he's cut them loose. Now, even Bank of America, his last big banking bet, is on the chopping block. Why? Because he's lost faith in the system. Buffett has seen enough banking crises to know that when depositors run for the exits, banks collapse. He watched it happen in 2008, and again with Silicon Valley Bank in 2023. He's not waiting around to see if the next crisis takes down a bigger bank. He straight up said the system isn't working like it should. If Buffett doesn't trust banks, why should we? And finally, Apple, the elephant in the room. Buffett has called Apple the best business he's ever owned, yet he sold 605 million shares in 2024. That's $138 billion worth of stock. A mind-blowing move for a guy who rarely sells his winners. Apple isn't in trouble, yet. But growth is slowing. iPhone sales are stagnant, and the stock's price-to-earnings ratio is at levels Buffett would have laughed at 10 years ago. So what do all these sales have in common? Buffett doesn't like what he sees. Whether it's overvaluation, shaky fundamentals, or a lack of trust in management and the banking system, one thing is clear: he's playing defense. And when Buffett plays defense, it's time to pay attention. Where did the money go? Buffett's $320 billion war chest. Warren Buffett just sold $150 billion worth of stocks. And now everyone's asking the same question. Where is all that money going? Did he secretly buy an island? Maybe fund a time machine to go back and buy Coca-Cola in the 1880s? Nope. He's hoarding cash like it's 2008 all over again. Let's get one thing straight. Buffett hates holding cash. He's said it 1,000,000 times. Cash is a terrible investment over time. But here he is, sitting on $320 billion in cash and cash equivalents. More than he's ever held before. And when Buffett does something he normally hates, it's not by accident. So where exactly is he parking this mountain of money? The answer: U.S. Treasury bills. Yep, Buffett isn't chasing AI stocks, crypto, or even gold. He's lending money to Uncle Sam for a couple of months at a time and earning a safe, steady return. Berkshire Hathaway now holds $288 billion in short-term U.S. Treasuries, which means Buffett has essentially turned his portfolio into a giant fortress of government-backed securities. Now, let's take a step back. Why would the greatest stock picker of all time, the man who preaches buy wonderful companies and hold forever, suddenly decide that the best investment right now is cash? The answer is simple. He doesn't like the price of anything else. Buffett isn't the kind of guy who buys stocks just because he has money to deploy. He waits for good businesses at great prices, and right now, he sees a market that's too expensive and too risky. He's been through enough bubbles to know that when prices get irrational, patience is the best strategy. Think about it. Buffett's been buying back Berkshire Hathaway's own stock for years because he saw it as undervalued. But in Q3 2024, he completely stopped buying. What does that tell us? Even his own company isn't worth buying at these prices. That's a major red flag. Let's not forget what happened the last time Buffett hoarded cash like this. Back in 1969, he shut down his investment partnership because he couldn't find anything worth buying. What followed? A brutal stock market crash, 4 recessions, sky-high inflation, and a decade of economic chaos. Now, I'm not saying history is repeating itself, but it sure is rhyming. Buffett isn't making a bet against the market. He's making a bet on reality catching up to it. The man has spent his entire career waiting for opportunities, not forcing them. And if he's waiting, maybe the rest of us should think twice before diving headfirst into an overheated market. The bottom line? Buffett is preparing for something big. Whether it's a crash, a correction, or just a long stretch of overpriced stocks, he's stacking up cash like a poker player waiting for the right hand. And when the market finally gives him an opportunity, he'll be ready to strike. The only question is, will you be? Buffett's Playbook. Is history repeating itself? If you've been paying attention, Warren Buffett's latest moves feel eerily familiar. The Oracle of Omaha doesn't just dump $150 billion in stocks, hoard a record amount of cash, and sit on the sidelines for no reason. This man has spent decades navigating market cycles, and when he goes into full-on defense mode, you better believe he sees something coming. So let's take a trip down memory lane. Back to 1969, when Buffett did something shockingly similar. At the time, he was running an investment partnership that had been wildly successful, returning over 30% annually for more than a decade. But instead of pushing forward, he shut it down completely. His reasoning? The market was too speculative, too expensive, and he couldn't find any good deals. Sound familiar? Now, what happened after Buffett walked away? Well, the 1970s were an absolute disaster for investors. The stock market crashed, inflation skyrocketed, unemployment spiked, oil prices went through the roof. The Dow Jones spent a decade going nowhere. Meanwhile, Buffett sat on the sidelines, waited for the dust to settle, and then pounced on bargains when everyone else was panicking. Fast forward to today, and it looks like Buffett is playing the same game. He's been cutting risk, stacking cash, and refusing to overpay for overhyped stocks. In fact, he's so cautious that he's even stopped buying back Berkshire Hathaway shares, something he's been aggressively doing for the past 6 years. If Buffett doesn't think even his own company is worth buying right now, what does that tell you about the rest of the market? This isn't about predicting a crash. It's about understanding that Buffett doesn't play the game the way most investors do. He doesn't chase hype. He doesn't follow trends. He waits until stocks are screamingly cheap before he makes his move. Right now, instead of playing along with the AI-fueled, tech-driven meme stock madness, he's sitting back, watching, and preparing for the next big opportunity. And let's be real, Buffett isn't hoarding $320 billion in cash because he thinks it's a good long-term investment. He's doing it because he knows that when the market eventually corrects, he'll be the one with the firepower to buy everything at a discount. He's not timing the market. He's waiting for the market to give him an offer he can't refuse. So, is history repeating itself? Maybe not exactly, but Buffett's actions sure are rhyming with what he did in 1969. And if past performance is any indication, we all might want to pay very, very close attention to what happens next. Conclusion: the Buffett Playbook. Will you be ready? Warren Buffett isn't just selling stocks. He's preparing for something big. He's stacking a record-breaking $320 billion in cash, staying away from overpriced stocks, and waiting for the right moment to strike. If history tells us anything, it's that Buffett plays the long game and wins. So, what should you do? Follow the herd, or take a page from the greatest investor of all time? At Money Mastery, we help you think like Buffett, spotting risks, recognizing opportunities, and mastering your financial future. If you got value from this, don't keep it to yourself. Drop a comment below, hit that like button, and make sure you're subscribed with notifications on so you never miss a game-changing insight.